Welcome back. You're with us on Bazaar Morning Call. Like we've been telling you, the cues are very, very green this morning. The tariff clouds have, dissipated, at least for now, which is why the implied open is suggesting that we'll be up 100 points straight away. Goes from there. Lots of individual stocks to track as well. Plenty of earnings that have come in after market hours. So we've got our team standing by with the cues and updates. But before we get to earnings, yesterday, of course, Shireen was, with the top secretaries at the budget town hall, and some very interesting takeaways came in, particularly on the next policy steps with respect to banks. Abhishek, good morning. Fill us in.
DFS Secretary has said that government has conveyed its view on LCR, that is liquidity coverage ratio, to RBI. But nothing has been heard from RBI's end to them till now. They don't want to lock up the additional capital in this regard, and that is what they have asked RBI for the concession on that. Now, what is LCR? LCR is liquidity coverage ratio. It's a liquidity requirement for banks to maintain at all times. It's a certain portion of high quality liquid assets which is called HQLA, which can be easily converted into cash, like bonds in the market, etc. So bankers have said that the draft guidelines of additional 5% will consume about 5 to 10%. That is the range that various bankers have given to us of the current level of LCR, which is on a tighter side to them. So that is why they have requested some leeway to RBI with respect to LCR's draft guidelines. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, let's hop across to Vivek. He's here to tell us about Power Grid's results. Vivek?
Well, good morning. A soft quarter as far as Power Grid was concerned. It's a miss across our poll. Revenues were down 2.7% on a year-on-year basis, coming close to the 11,233 crore mark. Our poll expected a revenue of a little over 11,600 crores. EBITDA was down close to 7% at 9,537 crores. This doesn't favor comparably versus our poll of a little over 10,100 crore. Margins too contracted on a year-on-year basis, 84.9% versus 88.5% on a year-on-year basis. And profitability was down 4% at 3,861. Our poll anticipated profit slightly in excess of 4,000 crore. But however, remember, Power Grid will depend on the kind of capex as well as capitalization guidance that the company will provide. The company gave a very strong guidance at the end of Q2. FY capex guidance was actually increased to over 20,000 crore from 18,000 crore earlier. In terms of the segmental revenues, the most important segment, transmissions, actually degrew this particular quarter, 6,545 crore versus 7,059 crore on a year-on-year basis. Expect a start in the red as far as Power Grid is concerned.
All right, Vivek, thank you very much for that. Let's talk about two more names, Tata Chemicals and Castrol, which should be in focus. Upasna's got details here. Upasna, morning.
Good morning. First up, let me start with Tata Chemicals. The numbers were a miss as compared to street estimates. Company says that the highest volume was offset by lower realization, leading to a miss in EBITDA and PAT. Now, company's revenue stood at 3,590 crore, down about 4%. This was mainly due to adverse price movement of soda ash while the volumes were higher. Company's EBITDA was also down about 20%, mainly on account of lower pricing, and EBITDA margins were under pressure, down about 240 basis points at 12.1% versus the street estimates of somewhere around 14.9%. Now, companies reported loss of 21 crore as compared to the profit of 194 crore. So overall, weak set of numbers. Moving forward to Castrol, the company's reported steady set of numbers this quarter. Revenue saw an uptick of 7% at 1,354 crores. Margin also increased by 180 basis points on a one-year basis, stood at 27.8 crores, while net profit was also up about 12%. So overall, steady set of numbers for Castrol and weak numbers for Tata Chem.
Got it. Thanks a lot for that, Upasna. Well, Vivek's here to tell us about KEC, Premier Energies, as well as NLC. Vivek, plate is full. Tell us more.
Well, that's right. Quite a few results yesterday. So first up is KEC International, a soft quarter in terms of execution as far as KEC was concerned. Revenue higher by 7%, EBITDA higher by 21.6%, margins at 7%. margin expansion on a year-on-year basis has been quite strong at 80 basis points. But this leaves the company with quite a lot of work to do, especially as far as Q4 is concerned, both in terms to meet the revenue guidance of 15% and also the margin guidance of 7.5%. Profitability was strong, higher by 34%. YTD order intake very strong. Remember, the company had given us a hint earlier in their interaction saying that they would be able to pass or exceed the order inflow guidance of 25,000 crore for FY25. They're already at 22,000 crore. Order book plus L1's position is now in excess of 41,000 crore, but expect a start in the red as far as KEC is concerned. Premier Energy, a very, very strong set of numbers. Revenues is more than double. In fact, 2.4x is the kind of revenues that you're seeing. EBITDA is up 4.2x. Margins very strong, 29.9, and profitability higher by almost 6 times on a year-on-year basis. Order book also very strong. In fact, seeing significant order book accretion as well. Order book at 4,539 megawatt. Order book value, when you're talking about the actual value, coming in at a little over 6,950 crore. Order inflows in this particular quarter was 2,239 crore. Along with that, the company has given the guidance across wafer, cell as well as module manufacturing facilities. Keep an eye out on NLC India as well. After a while, the company has delivered a robust set of numbers, improved operational performance. Profitability was also aided by strong other income. Importantly, the company saw the Ghatampur Unit 1 actually get operational this time around. Looking at the revenues higher by 40%, EBITDA doubling on a year-on-year basis, profitability up 167% on a year-on-year basis, mining revenues up 5.5%, power generation revenues came in very strong, up almost 40% on a year-on-year basis. Expect some green on NLC India as well.
Okay, all right, got it. Vivek, thanks very much. So looking good for most of them. For KEC, of course, we'll discuss more details with Mr. Kejriwal. He'll be joining us at around 9:30. Talk about that pickup in the order book and whether the margins can head higher from here on. Okay, let's go across to Vinny now. She's watching out for Gland Pharma. What's the latest, Vinny?
So Gland Pharma, they report the Q3 numbers, not an exciting one coming in. We're expecting red coming in for the screen. On screen for Gland Pharma. What is the main impact of this? Their base business, the main business of the company, that also was a bit of a disappointment versus the analyst expectation, as well as the Cenexi business, that's the CDMO business, that also didn't do that well. So overall, we're seeing a decline of around 10% on a year-on-year basis. When you look at it in terms of margins for the base business, the India business, that has managed to see a good growth. So that was a positive surprise. Though the revenue growth was not exciting, the margins was something that was positive because of the improved mix, is what the company highlighted. Cenexi business, an important update came in that, in terms of break-even, in terms of profitability, EBITDA front, that has now been postponed by the company to Q3 FY26. They were expecting break-even in Q4 FY25, so clearly a delay on that front. And that is something that could be impacting the stock going forward. As of now, in the near term is what we're watching out for. And today also, we are expecting a red because of this.
All right. Vinny, thank you very much for that. Garden Reach and DOMS are the other two companies in our focus. Back to Upasana. Upasana.
First up, let me start with Garden Reach Shipbuilders. The company has reported in-line set of numbers. Revenue saw an uptick of 38% to 12,071 crore, which was in line with the street estimates. This was mainly led by strong order book execution. Now, gross margins declined nearly about 1,080 basis points to 28%. This is likely due to the execution mix of the company. Now, EBITDA of the company surged by 55% in line with the street estimates, while EBITDA margins saw an uptick of 60 basis points to 5.9% on a Y-on-Y basis due to lower operating cost. Now, other income of the company fell by 12% and interest cost also spiked by 1.05 times, leading to a lower PAT growth than estimate. The company's PAT growth saw an uptick of nearly about 11% on a Y-on-Y basis, while the street was factoring in somewhere around 20%. Next up is DOMS. The company's margins are under pressure. EBITDA margin stood at 17.5% with a downtick of 110 basis points, and gross margins also under pressure, down about 90 basis points, stood at 43.5%. Now, company says that the increased selling and distribution costs due to consolidation of Uniclan Healthcare, higher employee expenses and ESOP grants led to the dented margins of the company. Now, revenue saw a strong growth of 35% on a Y-on-Y basis, and PAT also saw a strong growth of 40% on a Y-on-Y basis.
Okay, all right. Thank you very much for that. We'll watch out for DOMS and the others, Garden Reach as well. Thank you, Upasana, for that. Let's quickly head across to Manisha now. and see what the commodity cues are looking like, considering this whole tariff situation seems to have resolved itself for now. Manisha, morning.
Oh, well, yes, absolutely. U.S. putting 30-day pause on tariffs against Mexico and Canada, for one, has led to crude oil prices declining to a one-month low. OPEC and allies meeting that happened yesterday also will continue with existing oil production plans. Whether or not we see the 10% tariff on China is something that the street is looking for, and that uncertainty has led to the gold prices holding at all-time highs at around $28, $20 an ounce. We also have seen the metal prices rebound. So copper has come off its 4-week lows. Markets have seen China factory activity growth slow in January, but China resumes trade today. We have seen opportunity buying continue from China, and with the kind of weak data, 10% tariff or not, could lead to more stimulus measures coming in from China is where the metals seem to be taking support from right now.
All right. Manisha, thank you very much for that. We'll take a quick commercial break here. We're going to come back and get you that promised conversation with Pulkit Patni, India Industrials Analyst at Goldman Sachs, and we discuss the the sell-off that we've seen in the capital goods industrial side of the market and whether that is just temporary. So that's the conversation on the other side.